In 2008, a storm with no wind or frame blew away $10 trillion in assets worldwide. Millions of Americans suddenly found themselves on the street with a cardboard box, watching their home being foreclosed. Then on Wall Street, one true immortal collapsed overnight. People often call it the subprime mortgage crisis, but in reality, it was a case of greed, lie, and a blind faith that house price will never fall. This is the explanation of the 2008 financial crisis. In the early 2000s, the US economy faced great difficulty due to the dot-com bubble burst and the September 11 attacks. The morale of people and investors were shaking, pushing the US to the brink of recession. To save the situation, the US Federal Reserve Fed decided to drop interest rate to an extreme low from 6.5% to 31% in 2003. The goal was to flood the market with cash, encouraging people to borrow and spend. At this time, the mortgage became the center of attention. Simply put, when you want to buy a house but you don't have enough money, the bank lends you a large sum. In return, you use that very house as collateral for the loan. If you pay the monthly principal and the interest, the house is yours. But if you can no longer pay, the bank has the right to seize the house and sell it to recover their money. With the 1% interest rate, mortgage had never been cheaper. Americans feel confident that they could have a home while losing nothing. Because house prices were rising, they believe if they ran out of money, they could just sell the house to pay the debt and still keep a profit. Large investors also abandon government bonds to pour money into real estate. They need a place with higher return than 1%, but still safe. They choose real estate because they believe US house prices would only go up, never down. As demand for house soared, banks began to lower their lending standards. Even people with low income or bad credit were invited to take out a mortgage. These were the risky subprime loans. The entire financial system became completion. Both borrower and banks believed the house were internal insurance policy. This easygoing attitude created a credit craze, blowing up a giant bubble waiting to burst. To get more money to lend to home buyers, banks create a tool called MBS or mortgage-backed security. Imagine the bank gathering thousands of debt papers from people, bundling them into a pocket and selling them to large investors for immediate cash. They then use that cash to lend to more people. The money rotates constantly, helping bank make profit very fast. Investors receive monthly payment from the bank, which is the principal and interest paid by the borrower. It creates a perfect cycle. However, once people with good income has finished buying house, bank ran out of customers. To keep lending, they start giving money to people with no stable job or asset. These were subprime loans, or simply put, junk debt. To put this junk debt away, bank created an even more sophisticated tool called CDO, collateralized debt obligation. Think of a CDO like a seafood hotpot, pushed from leftover fish from previous days. The bank makes good debt people who pay on time and junk debt people likely to default into one pot. Then they divide this pot into different slides based on risk levels. The bottom slide is for those who like high risk for high returns. But if anyone defaults, the slide lose money first. The top slide is advertised as extremely safe with lower interest. So, who raised these CDOs? The pick of the fraud was the credit rating agency. Instead of warning investors about the junk debt inside, they labeled the CDO package as AAA, the highest safety rating, just to receive commission free from the banks. Investors worldwide saw the AAA label and believed they were buying gold. But in reality, that hotpot was full of rotten fish. The financial system was now like a Jenga tower, with the foundation made of rotten wood, just waiting for a light breeze to collapse. After years of cheap money, the economy hit up and inflation rose. To control it, from 2002 to 2006, Fed decided to raise interest rate continuously from 1% up to 5.25%. This decision was like a bucket of cold water thrown at the market. It created a butterfly effect, a small chain at the central bank causing a chain disaster worldwide. First, the subprime borrower began to suffocate. Rising interest rate caused their monthly payment to double or triple. They could no longer afford it. The inevitable happened. They lost their home and default. When millions default at once, banks began to seize home and auction them up to get their money back. The law of supply and demand kicked in, with too many houses being sold cheaply and no one daring to buy. House price fell into a free fall. Regular borrower suddenly realized, my house is only worth 100k, but I still owe the bank 200k. So they also decide to walk away. At this point, the cash flow into the NPS and CDO package we mentioned earlier was completely cut off. Investors received no interest, and banks were stuck with the house they couldn't sell. The biggest shock happened in September 2008 when Lehman Brothers, one of the largest and oldest investment banks in the US, declared bankruptcy. This was the gunshot suddenly that the financial system had collapsed. Banks began to panic and lost trust in each other. They stopped lending to one another because no one knew how much debt the other was holding. When the money stopped flowing, the global financial system froze, and a global recession began. The fall of Lehman Brothers was not just a US problem, because debt COD had been so global. When the foundation in the US cracked, the entire global financial castle shook. Banks in Europe and Asia suddenly realized the assets they held were just worthless paper. Just between financial institutions, finances, no one dared to lend, causing the blood of the economy to clog. The stock market began to fall vertically. Important indices like the S&P 500 lost more than half their value. In the UK, Japan, and across Asia, trillions of dollars of investor money disappeared in just a few months. The consequences gripped the life of ordinary people. When banks had no more money to lend to business, companies could not maintain production. This resulted in a massive wave of global layoffs. In the US, 1 million people lost their jobs and 2.5 million business closes. In Spain, nearly 40% of young people could not find work. These numbers represent the tragedy of millions of families losing their income and homes. The value of major currency fluctuated. Panicked investors pulled capital out of risky markets to buy gold or hold cash. The global financial system was like an engine of oil. All production and trade brought to a halt. Seeing the economy on the verge of total collapse, government could not just stand by. They knew if they did not act, the entire system would vanish. A massive rescue plan was launched. First with the TIRP bailout. The US government spent $700 billion of taxpayer money to buy toxic assets from big banks. The goal was to have banks clear out the financial strength so they could function again. The government also introduced the controversial concept too big to fail. They believed some banks were the heart of the economy. If they let them die, the whole economic body would die. So they used public money to keep these banks alive. Meanwhile, the Fed cut interest rate to nearly 0%. They hoped that with near zero interest, business would dare to borrow again and people would start spending to stimulate the economy to prevent history from repeating. The Dodd-Frank Act was passed. This was a set-up change for the financial world. It's for banks to keep more cash reserves and ban them for taking risky gamble with customer deposits. The 2008 crisis was not just an economic event. It was a painful lesson about human nature. It took more than 10 years for the world to truly recover from this loss. The first lesson is about trust. The financial system runs entirely on trust. When banks lie about debt quality and people borrow based on illusion, trust breaks, and then when trust is gone, everything collapses faster than anything else. The second lesson is about caution with cheap money. When interest rates are too low and making money seem too easy, we must ask, where is the trap? There is no such thing as a free lunch, and no asset, even real estate, can go up forever. The third lesson is for individual risk management. Never borrow beyond your ability to pay just because it's with talk from a consultant. Always have a backup plan for the when interest rate rise or the economic freeze. Finally, we realize that economic is not just a number on a screen. It is with steer and home of every family. A small hole in policy or a lack of responsibility in management can lead to disaster for millions. Hopeful, through this series, you understand more about 2008 earthquake. Always be a smart consumer, a wise investor, and keep a cool head in a very marketplace.